Hi, everybody. If you're new, welcome. I'm the investing teacher, a high school science teacher that also teaches others how to control their paycheck through trading. I've been successfully doing these strategies for over 7 years now, and I'm the founder of ThetaTraders.com, an online platform that provides one on one and group coaching sessions and option selling alerts. I have provided previous one on one sessions from other clients in the past in this channel. If you find the end of this video helpful, consider joining a 7-day free trial membership at thetatraders.com. Link is in the description down below. Let's get started. All right, everybody. In this video, we're going to go over the covered strangle strategy, the strike prices that I implemented at thetatraders.com about 1.5 weeks ago. And we actually got assigned on one of the short puts. So we're going to look at how to manage the strategy, different possible strike prices to look at, and why it's not the end of the world and could be quite profitable if you get assigned on one of the two short puts. Let's get right to it. Okay, so on this chart, you will see the backslash MES. This is the micro futures contract for SPY. This is backslash MES on Thinkorswim. And this is the primary futures contract that we're going to be doing the covered strangle on. You see the blue circle right here. When it got to a fairly low of the day, around the 40, it was around 41.20, I think it was, we were selling the put on the blue bar, and that was at the 4,000 strike price, and also selling the brown at the 39.50 strike price. And we had it expire right on Friday, which was the end of the day right here. On Friday, as you can see, market tumbled quite a bit in the last week and a half or so. We started with a 0.12 delta here in the blue bar. It was a 0.08 delta in the black bar. So we actually went over the expected move for the time period. And then the end of Friday, we actually did briefly touch the brown bar. The market turned up and we closed at around 39.74 in the end of Friday. So this means that I'm going to be assigned on this put contract. And over the weekend, I did get one contract of MES for it. The brown one did expire worthless. So we collected the full 100% of the premium on that one. We're going to go over the blog post to go over some of the technical details and what I'm going to be looking for with this covered strangle. Exactly how to set up and implement it and what happens during the covered strangle. So on February 14th, enter the covered strangle below. And I do give this to all yearly and lifetime Theta Traders members. So if you're interested in following along with me, also do one-on-one Zoom calls, private help as well. Feel free to join, and there's a 7-day free trial. So on 9 o'clock, we did fill this covered strangle. We received 12.5 in premium. There's a 5 multiplier on that, so about $50 in premium we received to start this trade. It was a 10-day expiration. The reason why we did 10 days is we actually closed out the previous one at a really good target profit because the market was going up before this. MES did close between the strikes, and I was assigned on that 4,000p. Right before close, when it was pretty obvious it wasn't going to hit the 4,000, I did sell a 4,000 call, and it expired on Wednesday. What's interesting is MES now has daily expirations. I could have even set up the trade where it closes on Monday if I wanted. I wanted a few extra days out because of commissions, and the premiums were a little bit better going a few extra days. But there was nothing wrong going out until Monday if you wanted to. I received 15.75 in premium for only a 5-day option at the same 4,000 call strike where I got a sign on the 4,000 put. So I actually received more income in less time just selling the call side than I did with the full covered strangle. And the reason why I like to start the covered strangle with 2 naked puts is you get entry in a lower stock price, or in this case, futures price, right? We're at 41 and change when I started this position, and I got signed at the 4,000, which again is more than one expected move away, and I get a better entry price on that point. I did sell another put to make it a pure covered strangle at this point. So I sold a 7 days out for next Friday, 38.50 put, and that peaked in 6.25 in premium. It's about a 0.12 delta at the time. So it's beyond another expected move for the week. And if I do get a sign on that 38.50, then I'll be in really good shape, I think, because my average cost basis on two contracts would be lower. Current cost basis is 39.65. The way to figure that out is start with your 4,000 assignment. You're going to subtract 12.5. That's what we took in the initial trade. You can also subtract 15.75 for the call side and subtract 6.25 for the put side. When you subtract all that out, the cost basis would be 39.65. And we start at 4,000 and we're lowering those cost basis based on taking in premium. If MES stays within around 3,900 to the 4,000 area, but doesn't go above the 4,000, plans to continue selling calls probably at that same 4,000 strike price. If I'm able to get 15.75 in 5 days, that's $78.75 in just 4 or 5 days, which is a very good premium considering the amount of funds you need, which is about $3,000. Now, if it happens to close above 4,000 on Wednesday, then the total return would be the premiums that I received, or 141.25 in about 2 weeks. That's a 4.7% return when the market dropped really heavily. It's a very good strategy to do, especially if you're relatively conservative in your strike prices. I typically like to go a little bit beyond what the expected move of the week is, and then you're able to get good premium while also getting good entry points. If MES does keep dropping and gets assigned on that 38.50, then I have two contracts, one at 38.50 and then one at 4,000. You could average those two contracts by buying, essentially taking the average of 38.50 and 4,000 and then divide by two, and also subtract the premiums you receive, divide by two as well on that to get your new cost basis. At that point, I would be selling two calls because I have two contracts, and I'd go probably around halfway, 3,900 level, continue to take in premium, continue lowering your cost basis on the two contracts. Now, the VIX right now is around 22. It was a little 21 and change yesterday. Premiums are very adequate right now to get those calls. And if you could get at least 10 premium in 4 or 5 days, that's $50 every 4 or 5 days off a $3,000 account. So that's my process going forward. You could also sell more deep in the money calls. In that case, you might lose some money in the actual contracts. You might be having to exercise lower than you bought it at, but you can receive more premium in those cases. And then if it does happen to continue dropping, you lower your cost basis even more. So me at Theta Traders, I like to start these covered strangles by selling those two naked puts. And I want to reiterate the reasons why. One is if you start the covered strangle by buying the contract, selling a call, and then selling one naked put, that is a technical true covered strangle. But by selling those two naked puts, I do get premium in both cases. And this usually ends up being pretty much the same as if I sold the same strike and an in the money call when I do the covered strangle normally. However, I do get less commissions this way, doing two contracts instead of three. Also, the lowered cost basis is very helpful. Market dropped quite a bit last week and a half, so there's a good chance of mean reversion where it might at least stay level or possibly bounce up in the next few weeks. And you also could get in a very adequate premium for a relatively safe position. MES is just like SPY. It's not one of these meme stocks that could necessarily move dramatically. Now it is futures, so you do have to be aware of your buying power and making sure that you don't use too much of it. But that's definitely some of the strategy that we cover at datatraders.com. So if you're interested in learning more and following along with me, you can join that 7-day free trial, datatraders.com. There's a link in the description down below. And happy trading, everybody.